Something truly unbelievable has just happened. This is one of the world's most powerful economic indicators, and it is flashing a warning to investors right now that we cannot ignore. I'm going to explain exactly what's going on and if this is likely going to lead to a recession or possibly a stock market crash in 3 simple, fast steps. Step number 1, let's go over this historic move in the labor market. The BLS just came out and downwardly revised the jobs numbers by almost 1 million jobs. And to give you some context, this is even worse than the downward revisions we got in 2009 during the GFC. Let's go right to the whiteboard, check out a chart. We go from today's date all the way back to, call it, the beginning of 2021. On the left, we go from 0 up to 1 million. This is supposedly how many jobs the U.S. economy was creating. This is non-farm payrolls. So we have this big rebound from, let's say, the cerveza sickness or the government's response to the cerveza sickness. So we have huge job growth going back to 2021. Call it 800,000. And then you can see what this trend is doing. It's going straight down to the point where just recently we saw a negative non-farm payroll. This is a huge deal. Why? Because we very rarely see something like this. Oh, here you go. Very big deal. I forgot that I wrote it right there. We very rarely see something like this outside of a recession or an economic contraction. And by the way, this chart doesn't even include the massive downward revisions that the BLS just released. This was about from April of 2024 to March of 2025. So said another way, if we would have had real data back then, a lot of these months, even in 2024, would have likely been negative. More on that in just a moment. So we have to ask, why on earth is the labor market so important to the United States economy? And why is this such a powerful indicator? Well, first and foremost, as most of you know, the United States economy is about 70% consumption. So that in and of itself tells you that if the labor market is decreasing, that means purchasing power is decreasing, aggregate demand is decreasing, fewer things are being bought and sold, therefore you are going to have an economic contraction. Very likely, in fact, you're going to have a recession if you start to see these non-farm payrolls go negative. But unfortunately, what we have to remember is usually these cycles get a lot worse before they get better. Why? Because it takes us into a labor market doom loop. So we have the unemployment rate, or the number of people working, let's say that's a better measurement, going down, and this reduces the amount of spending in the economy, which reduces the revenue and the profits for corporations, which incentivizes them to fire more workers, which increases the amount of people unemployed, and it just goes around and around in a circle, getting worse and worse and worse. So does this mean we're headed straight for a recession? Does this mean we're in a recession right now? Or does this mean that the stock market, which is at nosebleed levels right now, is going to crash, wiping out most people's 401k? Well, there are no certainties. There are only probabilities. But I'm going to give you my base case as to what's going to play out in markets and the economy in step number 3. But before we do, we've got to dive more into the details of what is happening with the labor market and interest rates. This is another extremely powerful indicator, maybe even more powerful than the labor market itself. I know I said the labor market's the number one indicator, but we'll say interest rates are tied for the labor market at that number one position. And what interest rates are doing right now is going to shock you. Step number 2, now let's go over those interest rates I was just talking about and compare that to what's happening in the labor market so we can draw some conclusions as to what the probabilities are that we're in or going into a recession or the stock market crashes. First and foremost, looking at the chart of a 2-year treasury, this is year to date. Now, what's interesting is the narrative around treasuries is that interest rates are going higher and higher and higher and higher. Foreigners are dumping treasuries. Investors are rejecting treasuries. I'm sure you guys hear these narratives all the time. So if I just ask the average person out there, what do you think interest rates have done this year? You would probably say, well, they're a lot higher than they were back in January. Well, let's look at the facts. Let's look at the data. So we can see that the 2-year treasury started off around 4.24, roughly. Right now we're trading at 3.54. So I'm not a math genius, but I think that is right around, call it 70 basis points, that it's actually down, not up. It's down. And you have to ask yourself, well, if there's no demand for treasuries, then how on earth are yields going down? That means the price is going up, for heaven's sakes. All right, but it's not just the 2-year treasury. Let's look at the 10-year treasury as well. And we see it's a similar story. Now, what I've got is a 1-month chart right here. We're going to zoom out and go to the year to date. But look at the 1 month. We started September, let's just call it right around 4.27, 4.25. And we have gone straight down today where we're at 4.08. And yesterday we were a bit lower at 4.05. So this is a big, big, big decline in interest rates, meaning demand for the 10-year treasury is going up. And what does that tell you about the overall economy? It tells you that growth and inflation expectations are declining. And another way to say that is GDP, economic output. The expectations for economic output are declining as well. Exactly what we're seeing in the labor market. But let's zoom out year to date to test the narrative that there's no demand for treasuries and interest rates are skyrocketing. Let's test that narrative against a chart, facts, data. We see that we started right around 4.56 or so, and within January we got to 4.8, maybe even higher. And then we've come straight down, call it 60 or so basis points, assuming that we're right here. Well, let's call it 50 basis points, 50 to 60 basis points, if we're going to be entirely accurate right here at the beginning of the year. And now we are at 4.08. So again, are interest rates up? No, they're down substantially, between 50 and 60 basis points, which is a big move in the 10-year treasury. But we're not done. A lot of people talk about the long bond, the 30-year treasury, and we can see these rates have plummeted as well. Why? Because of a very poor labor market signaling that growth and inflation expectations are declining. In other words, the economy is getting worse, and it was probably a lot worse than most of the people and the experts and the talking heads on CNBC and the mainstream led you to believe over the last, call it, year and a half. But when we also look at a year-to-date chart, we see that it's the same story to a lesser degree at the long end, where we started the year right around 4.78. Today we're at 4.72. So not a huge decline, but it's completely the opposite of the narrative that you're hearing, that there's no demand for treasuries and interest rates are skyrocketing. The main point here is the reason we have seen this overall drop in interest rates in 2025, and we have seen a rapid decline in interest rates over the last week due to the labor market data coming out a lot weaker than expected, is because this is the bond market telling you that the economy is slowing down. Now, does this in and of itself mean that we're going into a recession? Absolutely not. You have to combine this with the rest of the data to come to a base case as to what the highest probable outcome is. Oh, but wait, there is more. This is just one of the many warning signals we're getting from interest rates right now. Let me show you another one.
Let's go right over to a Fred chart of the interest rate for the reverse repo transactions with the Fed. Now, if you don't know what reverse repo is, this is basically a big money market fund or a financial institution that's giving cash to the Fed, and the Fed is paying them an interest rate. So this is a way the Fed actually tries to put a floor on interest rates. So right now we can see this reverse repo rate is 4.25%. So what we have to ask ourselves is, why would a financial institution that wants to earn an interest rate on their cash, why would they buy a treasury at a lower interest rate? Why would they do anything with their money at a lower interest rate when they could simply give the Fed their cash and be paid 4.25, basically risk-free? It doesn't make a lot of sense, does it? Unless you look at this through the lens of what's happening in the broader economy and what the predictions are from the insiders on Wall Street as to what's going to happen in the future. Let me show you what I'm referring to. Now, we said that the reverse repo rate is 4.25%. Now let's go back to that chart of the 2-year Treasury, and I'd like to remind you it's currently trading at 3.54%. So wait a minute here. That's a 70 basis point difference from reverse repo. So why on earth would any financial institution buy a 2-year Treasury at 3.54% when they could just park that money at the Fed and get 4.25? The answer is because they see economic storm clouds. They see what's happening in the labor market. They see an economic slowdown, possibly a recession, if not something worse, and they would prefer to have or lock in that 3.5% interest rate as opposed to giving that money to the Fed on a more short-term basis, where over the next 2 years that 4.25% could go down to, let's say, 1.25%. So number one, what this spread between the 2-year Treasury and reverse repo is telling you is that these financial institutions are predicting that interest rates over the next 2 years will be not just lower, but way, way lower. And it also tells you that there's other financial institutions that are buying these 2-year Treasuries and taking that haircut because they think there's going to be a huge opportunity to re-lend them and make more than the 70 basis point haircut they're taking to begin with. And why would that happen? If the stuff hits the fan, there's a liquidity freeze, there's a liquidity crisis, and everyone needs the collateral that those financial institutions just happen to have on their balance sheet.
Step number 3. So here's my prediction. Here's my base case as to whether or not we are headed for a recession or even a stock market crash. Now, before we go any further, let me reiterate, this is all about probabilities. There are no certainties. We just have to look at the odds and come to a conclusion based on what is most likely going to happen, and then position our portfolio accordingly. So this is the key. There are no certainties, only probabilities. That's what we're talking about right here. So we went over this chart in step number 1. I said this is a very big deal where the non-farm payrolls went negative, but what we can do is go back in time and see if this has happened before where we have avoided a recession. Editor, go ahead and throw up a chart of the 1970s non-farm payrolls, and we can see they definitely go negative during a recession, but there are times when they go negative and we don't have the stuff hitting the fan. And if we fast forward to the 1980s, we see something similar. 1990s, 2000s, 2010s. We can see that occasionally, we do get a negative non-farm payroll, and it's kind of a nothing burger. But when you actually dive into the details and do the research, you find that most of these anomalies are due to things like a huge strike at Walmart, or a big employer in the United States, or some massive, massive weather event like a hurricane. And to be clear, you do have the occasional non-farm payroll that is a nothing burger, but it's very, very rare. outside of these weather events or big strikes or big employers laying off people because oil is going down or something like that, outside of those reasons, usually you have negative non-farm payrolls in or very, very close to a recession. But here is the key. It's all about the trend. You see, when we have these one-off events, usually the non-farm payroll is kind of chugging along like this, and then it just goes dips down and then boom, straight back up, or maybe even a little bit higher, something like that. What we have right now, going back to 2021, is a defined trend down lower and lower and lower and lower. And let's not forget that with those revisions we talked about before, a lot, or at least a couple, of these non-farm payroll numbers in 2024 would have actually been negative. And keep in mind, we haven't had the final revisions for what we've seen in 2025 yet. So we very well could see the majority of the months negative in 2025 right now as we speak. So what do I think the odds are that we're in a recession or headed straight to a recession right now as we speak? Based on the interest rates, based on the labor market, I'd give it about 85%. Now, does this mean the stock market is going to crash or we're going to have a bear market? Well, let's dive into that a little bit deeper. So editor, go ahead and throw up a chart of the S&P 500 in 1974. We see a huge bear market. I would call that a crash. And then editor, throw up a chart of 2000. We know what happened to the S&P then. We definitely know what happened to the S&P in 2008 during the GFC. But now let's go ahead and throw up another chart of the recessions we had right around 1980. And we see the stock market didn't go down that much. Well, what was one of the variables here? Well, the common denominator that we had going into 1974, into 2000, into 2008 were the PE ratios for the S&P 500, or the average PE ratio, was very high, close to, if not higher than 20. Where if you look at 1980, you see that going into that recession, where the stock market didn't go down that much, the PE ratios were extremely low. Meaning here and here, stocks were really expensive. Here, they were really cheap. So the next question becomes, well, George, where are they right now? Editor, go ahead and throw up a chart, and we can see that today, PE ratios are at nosebleed levels. In fact, they're higher than they were in 1974, 2008, and very close to the levels we saw prior to the dot-com bust. So taking all that into consideration, I would say the odds of a stock market crash, assuming we go into a recession, is probably around I would say 20%. Why? Why so low? Because I believe in today's day and age, if we did have a severe downturn like we saw during the GFC, or let's just say a quick downturn like we saw during the cerveza sickness, the central planners would come in and do something. I don't know that the monetary side of the equation would really work, but they're going to do fiscal. They're going to do anything in their power to try to prop up those asset prices that are so important to the real economy. But what's interesting is I think the worse the recession is, the lower the probability that the stock market stays down by, let's say, more than 20%, meaning a bear market, for an extended period of time, because the worse the recession is, the faster the central planners are going to come in. But if we have just kind of a garden variety recession and you have a bear market, just a very slow grind down lower and lower and lower, then I would say the odds of the market going down by, let's say, 30-40% are actually, believe it or not, much higher. And I think that would go up to probably 40%. So to put in very simple terms, if we do have a GFC type of event, I would say there's only a 20% probability the stock market is lower in a year than it is today. But if we have a garden variety recession, kind of like a dot-com balance sheet recession, then I think there's 40, maybe 50% chance that the stock market is not only lower in a year, but significantly lower, probably 20% plus. So you can see the most dangerous thing you can do right now as an investor is just what everyone tells you is the smart thing to do. Well, just buy and hold, buy the dip. But here's the good news. I know a lot of you right about now are watching this video and saying, okay, George, I get it, high probability because everything's going on in the labor market, interest rates, stuff's going to hit the fan. And there's a reasonable probability that my 401k or my stock portfolio takes a big hit over the next year. But what do I do about it? Well, fortunately, there are proven strategies and methods that the average investor, just like you guys watching this video, can use to not only protect your wealth, but to build wealth and thrive in this crazy world we live in of out-of-control central banks, big governments, and a deteriorating U.S. economy. If you want more information on one of the most powerful tools the average investor has at their disposal to navigate exactly what's going on in the markets and in the economy right now, I'll put a link in the description below.